Hey, future millionaires? Real estate or stocks, which one will build your wealth faster? In today's video, we're diving deep into the battle of the giants, real estate versus the stock market. If you've ever wondered where to put your money to get the best returns, lowest risk, or even create passive income, this is the video for you. I'll break down the pros, cons, real numbers, and even what I personally recommend depending on your goals. Stick around till the end because I'll also reveal which one performs better long-term and who it's best suited for. This is the wealthy path. And if you're serious about mastering your money, hit that like button and subscribe because we break down money like no one else. Then you can make the best choice for your own financial journey. We're going to break this down in plain English. No jargon, just straight talk about building that wealth you're after. Let's start with the basics. What does it mean to invest in stocks? You're buying small pieces of ownership in companies. Think Apple, Amazon, your favorite coffee shop, anything that's publicly traded. You're betting on these companies to grow and increase in value. When they do well, your investment grows too. Real estate is a bit different. You're buying physical property. This could be your own home, a rental property, or even commercial space. You're betting on the value of that property going up over time. You can also make money from rent if you have tenants. Both stocks and real estate offer ways to build wealth. They're both long-term games. You're not going to get rich overnight with either one. But understanding the difference is key to choosing the right path for you. Let's keep going. Everyone wants to know about returns. How much money can you make? Historically, the stock market has averaged higher returns than real estate. We're talking roughly 10% per year for stocks versus 4 to 5% for real estate. That's a big difference. But wait, there's more. Real estate has a secret weapon leverage. You can buy a property with a loan from the bank. That means you're only putting down a portion of the actual price. When the property value goes up, your return is magnified. Let me explain. Let's say you buy a $200,000 house with a $40,000 down payment. That's 20% down. The house value increases by 5%, which is a $10,000 gain. Since you only invested $40,000, your return is actually 25%, $10,000 gain on a $40,000 investment. Leverage. Section 4. The risk factor, volatility versus hidden dangers. Higher returns often come with higher risks, and the stock market is no different. Stock prices can fluctuate wildly. Remember the market crash of 2008? People lost a lot of money fast. Stocks can be volatile, and that can be scary for some folks. Real estate is often seen as more stable. They're not making more land, right? But that doesn't mean it's risk-free. Remember the housing bubble burst in the mid-2000s? Property values plummeted, and many homeowners lost their shirts. Real estate also comes with hidden risks. What if your rental property sits vacant? You're still responsible for the mortgage, property taxes, and maintenance. What if you have a major repair? That eats into your profits. Both investments have risks. You need to choose what you're comfortable with. Section 5. Time is money, passive income, or hands-on hustle. One of the biggest differences between stocks and real estate is the time commitment. Investing in stocks can be relatively passive. You can buy index funds or ETFs, which track the performance of the entire market. You set it and forget it. Real estate is a different animal. It requires active management. You need to find tenants, deal with repairs, and handle all the headaches that come with being a landlord. It can feel like a second job, especially if you have multiple properties. Of course, you can hire a property manager to handle the day-to-day tasks, but that eats into your profits. Real estate can be very rewarding, but it's not for the faint of heart. It takes hard work and dedication. Section 6. The taxman cometh advantages on both sides. Uncle Sam always wants his cut. But the good news is that both stocks and real estate offer tax advantages. With stocks, you can hold on to your investments for the long haul and benefit from lower capital gains taxes when you sell. Real estate has its own set of tax perks. You can deduct expenses like mortgage interest, property taxes, and depreciation. This can save you a bundle come tax time. And if you ever sell your primary residence, you might be able to exclude a sizable chunk of your profits from capital gains taxes. It's important to consult with a tax professional to understand all the ins and outs of these benefits. Tax laws can be complex, and what works for one person might not work for another. But knowing the tax advantages can make a big difference in your overall return on investment. Section 7. Finding your path. Which investment is right for you? So, which is it? Stocks or real estate? The answer is, it depends. It depends on your individual goals, risk tolerance, and how much time and effort you're willing to put in. Are you comfortable with some risk and volatility in exchange for potentially higher returns? Stocks might be a good fit. Do you prefer a more tangible investment that you can see and touch? Maybe real estate is more your speed. There's no one-size-fits-all answer. The key is to educate yourself, understand the risks and rewards of each investment, and make an informed decision that aligns with your financial goals. Remember, building wealth takes time and patience. There are no shortcuts.